Good afternoon and welcome to Markets Today. Today is the 21st of January 2020 and I'm your host, Mbithe Mwema. Now, when we are looking at 2020, there's a lot of discussion that's ongoing with regards to the economic outlook as well as the investment outlook, either for equities, real estate or fixed income, depending on what asset class you're interested in. Earlier this morning, Genghis Capital did launch its 2020 Playbook, highlighting its investment thesis for the different asset classes, as well as its outlook for the economy in the year 2020. Now, Genghis has taken a bit of a contrarian view. What are their views and what's driving them to be on the contrarian side with regards to the outlook for this year? This is a conversation that we are going to have in studio this afternoon, and we are joined by Mr. Patrick Mumu, who's an investment analyst at Genghis Capital. Welcome to the show.
Thank you for having me.
Congratulations on a report that is well written. You did have the launch earlier in the morning. What is your thesis with regards to investments and the macroeconomic outlook for 2020?
So looking at the general market, we've seen mixed reaction from investors, and what we're expecting is that investors will settle at the short end of the yield curve that we are seeing most investors look at, because when there's risk in the economy or perceived risk in the economy, many investors keeping away from the long term. So in the fixed income market, we're seeing investors keeping to the short term, whereas in the equities market, we are looking at mixed reaction again, but most investors are looking to profit take in much of the counters which rallied in the fourth quarter of 2019, the key counters.
Okay, fantastic. And when you were presenting to a broad set of investors, did you get a sense of what the investor sentiment is? In other words, are they in agreement with what you're thinking, or are they a bit bearish or slightly more bullish based on what you're thinking?
What we got from our feedback from our investors was quite positive. They can see that there are short-term fluctuations, because the theme of the report is, yes, we are seeing value in many of these counters, long-term value, and some of those counters we have a buy recommendation on them, but in the short term, looking in the next 3 to 6 months, we are seeing downward pressure in the market. Okay. Investors are looking to profit take, they're looking to move out of certain counters, and that's creating that friction. And our market, again, is controlled largely by foreign investors, and the ones who are driving this push. So it's likely that we'll see some short-term
downward pressure on equities. Okay, I like the way you've broken down the report. There's a macroeconomic outlook, fixed income outlook, equities outlook, and for the first time, derivatives outlook. This is the first time I'm seeing an investment house actually looking at the investment case for derivatives. Maybe you can walk us briefly through the different segments. Let's start off with the macroeconomic outlook. Broadly speaking, what are your expectations for the key parameters when you look at the macroeconomy?
So when we're looking at the economy, we're expecting GDP growth in 2020 to come in at 5.7%.
Okay.
This is a rebound effect from 2019, which is yet to be released. We're expecting 2019 to be at 5.6, slightly lower. And this will largely be driven by the services sector. I think the key factor most people look at when they're assessing GDP is that we're not feeling this perceived growth or country growth on the ground. And that largely, the big metric we're looking at there is the private sector credit growth, because that is expected to spur growth in the private sector and also in the wider economy.
Okay.
And in terms of the private sector credit growth, it has been quite weak. With the removal of the caps, that is also renewing investor confidence, but we anticipate that it will not be as robust as the pre-cap era, because pre-cap, 15 months before the caps were introduced, the private sector credit growth was growing as high as 20%.
20%?
Yes, and by the time caps were being introduced, it was at 5.4, and there were real concerns around the asset quality in the sector. At this point, banks weren't lending because of non-performing loans, not because there's a cap or they couldn't price for risk.
Okay.
Right now, caps have been removed 3 years
so it can actually, okay.
So banks are looking at that situation. Again, the asset quality has deteriorated over the same period of time. NPLs then were 8.8%. Currently, the non-performing loans are 12.3%. So it has worsened over that period.
It certainly
so
has.
Banks are taking a very cautious approach. So we don't really expect private sector credit growth to really ramp up and grow rapidly. And that, again, will affect many of these companies and the economy in general. So we might not necessarily see that 5.7% I'm talking about translating very directly on the economy, especially in the short term. In the long term, it has potential to do that, but that also depends on government and fiscal consolidation in whether they're able to achieve their targets.
Okay, so 5.7%, this could potentially get higher depending on private sector access to credit. Do you see a scenario where we get to 7%, give or take, because that is what Treasury is actually communicating with regards to its medium-term GDP outlook. Is 7% feasible, maybe in another 2 to 3 years?
I don't think it's feasible because, again, we have to look at the fiscal constraints they have. Remember, we have a very huge debt load. We can't go into spending. To grow the economy, you're required to spend, and you can't spend that money if you're not able to raise it. Revenue is underperforming year in, year out. And the other alternative is debt. You're already very concentrated on the foreign debt. In the local market, influx of debt or high demand of debt will lead to pressure on yields, and that might be detrimental to the economy. So I really don't see us getting
to that level. Yeah. What about your outlook on inflation for the year? What is that going to look like?
So for inflation, we think it will be quite stable between 5% and 7%. This is the upper bound of the government target range. And the reasons for that is because one of the key factors, global oil supply, is expected to be relatively constrained. The global economy is not expected to grow as robustly as it has in the previous years. It's also expected to be a slow, relatively slow year in the global economy. So that usually drives oil demand lower, and that will lead to relatively stable oil prices, and that should again have an effect on our inflation levels being quite steady. So we don't really expect much volatility on that end.
Okay, so inflation more or less stable. Yes. What about foreign exchange? The exchange value of our currency vis-a-vis some of the global currencies, most largely being the US dollar.
For the currency, we're expecting it to be quite stable, to oscillate between 100 and 104.
Okay.
Yeah, there's been improvement in forex reserves in terms of some of the projects the government was carrying on, and the amount of imports required to complete those projects or undertake those projects. Those have slowed down significantly since 2 years ago. I think we even saw the impact of that last year, and the currency actually appreciated because of that slowdown. And the improvement in diaspora remittances as well was a big plus also in year 2019. Looking at this year, we think the forex reserves will be quite stable, and on top of that, there'll be, or we expect that there'll be an IMF standby facility which will really cushion the reserves, allay fear among the foreign investors, and that will lead to lower yields and lower borrowing for government, and that will be a conducive environment to keep the currency
more or less stable. And then lastly, on the macro, what about the outlook on interest rates, and largely what decisions the MPC through the Central Bank of Kenya will take?
So for the MPC, they have a meeting this coming Monday. We're expecting them to leave rates as they are. Our MPC has been known to have a wait-and-see approach whenever they carry out monetary policy, and we expect that to continue to this meeting. However, we forecast that there'll be a further rate cut sometime in the year, probably in the next meeting from this one, or the July meeting, and that will be preceded from now having looked at private sector credit growth in the economy, and possible pressure on factors such as the currency and inflation, which we again expect to be very stable.
Do you have a sense as an investment house whether the cut comes in at about 50 basis points, or is it a 1 percentage point, or is the general direction expect a cut at some point during the year?
We expect a 50 bips
50 basis
cut,
points.
yeah, because they are quite conservative, and we expect that because a 100 bips cut will be very, very radical, if I may call, following, especially given that they'd already cut it by 50 basis points before. Yeah, so.
All right. Is there anything else in the macro that could possibly be a risk factor when we're looking at the year 2020 from where you stand?
I think we've mentioned the major ones, because what really stands out is fiscal consolidation. And when we talk about fiscal consolidation, there comes the story about debt. Shilling, there have been suggestions that it's possibly overvalued, and that's where investor concerns come in, especially on the foreign end. And I think we have touched quite solidly on those ones. Those are the key risk factors, I'd say, from the macro point of view that will really affect our economy.
And what about politics? When everybody talks about BBI, His Excellency President Uhuru Kenyatta last week did come out and have a State of the Nation address. And one of the key things he said is, let's move away from being a political kingdom towards being an economic kingdom. Does politics factor in when you're looking at the outlook for 2020?
Yes, in fact, in our playbook, we
Yes.
have put the expectation that we expect a referendum at the end of the year. We think that it's being pushed very candidly and very strongly by certain political quarters, and we expect at the end of the year there'll be that that political tension also, which will have also some effect probably on the market. But our experience from political events in the past is that markets tend to react way before the political event occurs.
Okay, so a bit of weakening.
Yes, so if the referendum is probably going to happen in the second half of the year, you'd find that towards the end of the first half of the year, or somewhere 3 months or 6 months before that actual event, that's when markets will react. During the events, if you look at elections or the repeat elections, or even the both elections, 2013 and 2017,
Yes.
you find that during those periods, market has not really depressed, but rather the market reaction occurred before the actual event here. So
Okay.
we're expecting some pressure probably on the markets in the first half in anticipation of that,
In anticipation of that.
Yeah, especially when it becomes quite apparent that it will happen.
All right, so expect a referendum and look out for a slight market correction, at least on the equity side. Is there a sense of what to expect on the business cycle? If there's going to be a referendum, do you think that the companies will continue to invest in capacity expansion? Do you think this will have an impact on consumer demand, at least for the next 12 to 18 months?
We don't think the impact will be really significant, because I said when you look at the event, the elections usually have the biggest input. I think what you can compare the referendum to
Yes.
is not really an election. It is a political event, but what you can compare it to is the previous referendum which we voted for the constitution.
Okay.
Yeah, and during that period, market really business sentiment really didn't slow down, because it's just a changing of the rules. You don't really expect political instability or violence escalating from a referendum. It's just a build-up.
Just a build-up.
Yes.
Okay. Thank you so much for that summary. Let's go to the next part of your report, and this is looking at the fixed income outlook. When you're looking at fixed income, what are we looking at as Genghis Capital?
So in the fixed income market here, we are primarily looking at yields and fiscal consolidation. And in terms of fiscal consolidation, government increased its domestic borrowing target, which again is expected to imply higher pressure on yields, especially in the short term in the T-bill market. And again, remember there was the removal of parastatals, or rather from the market, because they had to submit back the funds which they had, the excess funds which they had. So they were a big player, contributing around 6%.
Oh,
of the
6%
total
is
flows.
big. Okay,
yeah.
That would explain the demand and the uptake of treasuries as well as bonds.
Yes, so that's weakened demand, coupled with the fact that the interest rate caps were removed, means that yields become less attractive if they are very low, if government, or rather CBK, persists with the aggressive, disciplined approach of keeping rates very low. So we might see some pressure on the short-term government yields.
Okay, on the short-term yields. But let me bring you back to this. So something interesting that happened this and last week, at least a conclusion that I was able to arrive at, there was a listing of the green bond on the London Stock Exchange. What I found very interesting was the fact that His Excellency, the President, had actually accompanied the team to the London Stock Exchange bell ringing ceremony, which really means a lot, because that's a lot of clout that you're getting from an executive office level. But what stood out for me was a couple of things. The government, United Kingdom has pledged about 170 billion to give to Kenya with regards to different sectors. But there's been an ongoing conversation of a possible issuance of a green sovereign bond to be able to tap into this market and get direct funding for some of the projects. Now, you're saying on one end, some demand for government debt has been taken away, especially through the parastatals. Have you had anything in the pipeline with regards to a possibility of a green sovereign bond? And do you think Kenya could go in that direction?
In terms of a green sovereign bond, the terms are usually extremely strict.
Okay.
They have to be financed in a particular way. What I've seen in the past is government talking about financing or rather floating infrastructure bond, for example, the 150 billion which the president also alluded to. But when you look at the reasons for floating that bond, it was to go, partly was to go to infrastructure, part of the funds will also go to the county government. So you see it's an infrastructure bond in essence, but the reason it's an infrastructure bond is to attract inflows. It's not really going to the defined
Particular
purpose.
project.
Yeah, so the green sovereign bonds
has
will have
to be aligned.
Yeah, has to be aligned, and that's an area I think government would struggle to really justify why they will need to float a bond, particularly on that segment.
Okay.
Yeah.
And what about sukuk bonds? I know it has been an ongoing conversation, but then the legislation is not very clear whether the regulations permit for this. Is this something that you have had ongoing, something that's about to happen anytime soon?
Yeah, occasionally there are rumors in the market that there are talks to enhance it, but from experience and having looked at subscriptions of many government initiatives, Emakiba being one,
yes.
there have been so many initiatives to try and mobilize money for the government for borrowing. And if you look at most of these initiatives, they haven't been very clear in what the government is looking to achieve or where the funds necessarily are looking to go. So even the sukuk, the green bond, I think they'll get they will get challenges, but it has to be clear. For that's something very which investors are very keen on, especially the foreign investors. They want to know where the money is going, what it's going to do, and whether the projects are feasible. Remember, we have a history of conducting projects which are not.
Okay, so it has to be very clear. So
yes,
in other words,
and feasible.
There's probably the opportunity for the government of Kenya to be innovative in how it attracts funding for its projects. But for it to be innovative, it will have to be slightly more accountable for how the use of proceeds is actually executed on.
Yes, whether the projects are feasible
or not.
Yeah.
Okay, we'll take a quick break before we go. Just a quick break. When we come back, we'll take a deep dive and understand what is the outlook for equities for the next 12 months. See you in a few.